Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Are you interested in multifamily real estate either now or in the future? Is that something that you want to do later? And I'm talking multifamily on a large scale, demographically desirable land sites and existing apartment communities. That's what we're talking about this episode with my guest, Michael Zaransky of MZ Capital Partners, and you'll hear us talk about it. We've both been in the game for a long time. This is an episode that you can learn from because we've been through it. Let's go. This is episode 133 of Zen and the Art of Real Estate Investing with my guest, Michael Zaransky. Michael is the founder and managing principal at MZ Capital Partners. They concentrate on investment, property acquisition, and development. Michael has been in it a long time. We were just chatting before. I'm really excited to have his experience on the show. Michael, welcome to the show.
Thank you, Jonathan. It's a pleasure to be here.
Yeah, it's a pleasure to talk to you. And like we were saying before, it's nice to talk to someone who's been through the cycles so we can help some people who are dealing with these newer cycles of real estate. But when was the first time that you got started in real estate? How old were you?
I got started right after I graduated law school. I never practiced law. So I was, no one asked me my age, 24 years old. So a long time ago.
Yeah. And what was the impetus to draw you towards real estate when you decided you weren't going to take the law license and use it as a traditional lawyer?
Yeah, I really always was drawn to real estate. I grew up in a family of real estate entrepreneurs. My grandfather was in it. He was an immigrant to this country. He was in it all over Chicago. My dad dabbled in owning real estate as well. And I went to law school really for the business background. I never interviewed for law positions. I found it to be a great background, and I kind of hit the ground running when I graduated.
Yeah, I agree. I'm a lawyer. I did practice, though, for 10 years, but my dad was a lawyer who never made money as a lawyer. He made it all in real estate, so I have a family background as well. Did you know, even when you were younger, like as a kid, was it interesting to you to see what your grandfather and your father were doing with real estate?
It was interesting. I remember sometimes on weekends taking rides with my dad and walking buildings.
Oh, me too.
Picking up applications, that were handwritten because, of course, there was no online application. Yeah. And I was kind of drawn to it.
Yeah, I agree. I learned a lot pre-internet, for those of us who were operating back then, because it was just a little easier to be human to human at that time. There's a lot of things that you can put technology in the middle. How do you feel now compared to back then? Do you think it's gotten better or worse in general?
I think in general better, easier, better, but there are disadvantages. Things sometimes move too quick. I think that the inclination that we all had was the internet was going to make our quality of life easier. It would free up time, but it's really turned us into having to work 24 hours a day, 7 days a week, especially when you factor in people in different time zones in the real estate business, either applying for apartments or trying to broker a deal. It just, you're always on.
Yeah, and I mean, you've had your license as a broker since 1979, but do you remember what it used to be like? I try to tell people, because now everything's at their fingertips with Zillow. There used to just be books with one photo and paper that you would go through to go see properties with your agent, right?
Totally remember. You'd wait for the book to come out.
Yeah.
And you'd kind of go through it and then meet at the property. And then not only that, actually, if you ended up buying it, actually ended up attending in person a closing with a cashier's check, sitting at the table with the seller and the lender oftentimes.
Yeah.
And then when you went to the point of having to find tenants, actually having to run an ad in what we used to call back then a newspaper. It's on paper. And
absolutely.
Someone at the apartment in person and showing it to them and having them fill out an application to apply for the apartment and take them back to the office to figure
those
out.
were phone call employment verification and everything else. So it was a whole different story.
Yes.
Yeah. So when you got started and you decided you actually wanted to put money into real estate, what was the first asset class that you looked at back in the original days?
The first asset class I actually dabble in because it seemed easiest and less intensive was triple net leased properties.
Oh, interesting, though. That's an interesting start, though, even back then to get into that. How did you find your way into that to start? Because it's a great option that not a lot of people still really know about. So what was your road to that?
I was really kind of looking for something that was easier to manage and something with a quality tenant. And I discovered several, and as well as transaction size, several of the net lease properties are smaller deals. I actually owned for a while 3 or 4 small U.S. post offices.
Wow.
That were net leased to the federal government. I figured that's a pretty good tenant.
That should be as solid, as you could get.
Yeah, a couple of banks. And what was interesting at the time was I ended up buying the properties when interest rates were very high or relatively high, speaking of cycles. And I ended up selling the properties many years later and used that money to fund other larger purchases at a pretty substantial profit because interest rates were down. I was too stupid to know that when I was buying at high interest rates that the value of the asset would go up when interest rates went down. But I got lucky and did. And I learned about cycles, and particularly on triple net leases, the net operating income and after debt service is really what drives the value. So they were worth more. And I used that money as seed money to go into and transition into multifamily and larger deals.
Yeah. Did you know from the beginning, though, that you wanted to have a little bit more of a distant relationship from the asset? That's how it starts. Triple net is hopefully pretty easy because you're locking in on these tenants that are going to be there maybe 50 years or more.
Yeah. It was also a little bit boring and, not as hands-on. And, but they were, relatively small and easy to do with limited capital.
Yeah.
And I knew I wanted something more, and I fairly quickly transitioned into the multifamily space.
Yeah. When you moved to multifamily, did you go right to apartments or did you start with smaller versions?
Yeah, right to apartments, but smaller buildings. I bought a couple of 6 flats in the Chicago market. Chicago has kind of a standard style 6 flat with a center entrance and 3 units on each side, 3-story walk up.
Yeah.
Got to know that product well. I bought them in emerging neighborhoods and was able to grow rents, keep them occupied, and eventually sell those and do tax-free exchanges into larger buildings.
Yeah, specific to Chicago, though, because you're talking about identifying emerging markets, that's still really a play in Chicago. It always has been. To be the best at real estate in Chicago, you have to be on top of where the markets are changing because it can be very close to different areas that you could get it wrong, right?
Yeah, I've since expanded our footprint nationally to other states. But what I learned from that early experience, and still even in those markets, and I'm always reminded, is that real estate's a very local business. And just throwing out a name of a city just because it sounds great, like Austin or Nashville or Charlotte, doesn't mean very much unless you know neighborhood by neighborhood and almost block by block where you're buying and see the signs of what was emerging. Back then, my quick test of an emerging market was if Starbucks located in the neighborhood. It doesn't work very much anymore because they're everywhere.
Yeah.
Back then, they were kind of ahead of the curve on their demographics and market research.
Yeah, I still think that there's other companies that you can use now that are viable representations of emergence. But like, yeah, it went from there to Whole Foods to Trader Joe's.
Yes.
At a time, I really liked Subway. I thought that Subway, they almost seemed to never go out of business until the pandemic, and then we saw that happen. But that's interesting. Did you use those type of things though when you started to choose other markets outside of your main market in Chicago?
Yeah, absolutely. When got down to looking at buildings and learning about other markets before I actually had an acquisition there, I would go and drive and use those kinds of things, like see if Starbucks is there, if Walgreens or CVS. If Walgreens or CVS was on the same corner, kind of head to head, that told me a lot about the area and growing. And of course, Trader Joe's and Whole Foods was a home run for demographics as well. It's interesting that you had a similar approach as an entrepreneur to let the bigger, larger firms with the massive research and demographers figure out for us what's emerging.
Yeah. I really like what you said before, because I've always said, real estate news is great, but real estate is local. And you just said that. But this goes to show that the old ways of stuff that we did still work. You really do have to know your neighborhoods. I get a little worried for people who invest without having any knowledge of like an outside area to walk through the area and see what the development actually looks like, because you can't learn the full scale of block by block from Google Street View.
Yes. I think not only just driving the area and walk through the area, but different times a day, visiting the neighborhood on the weekends, visiting the neighborhood and maybe parking on the block of a subject property at night.
Yeah.
What's going on there, see what's going on the different corners. Really gives you a great feel for the neighborhood. And I haven't done it in a while because I've kind of learned the areas where I now invest. But in the beginning, I used to be fond of getting on a bicycle and riding the neighborhood and hanging out at the local coffee shop and up and down the streets. You really get a feel for it.
Yeah, I think that's great advice right now. I mean, there are obviously a lot of resources there, but if you really want to hone in on an area, it's nice to get to know more. You'll get a lot more information. Who knows who you could bump into and find out something about the path of development that you might not know from someone else.
Right. I think today, because of availability of data, anyone at some point in the learning curve knows how to do a spreadsheet or look at a broker's pro forma and pick it apart and analyze and produce your own pro forma and, see where expenses should be and come up with a good guess on where rents will grow or how much based on comparable properties. But that other part, that intangible part, I think is something that people forget. And the institutional investors that have investment committees and analysts that work Excel sheets all day and make decisions without getting their hands dirty and feet on the ground, I think trip themselves up very often.
Yeah, I mean, they've proven it over and over again, the mistakes that they've made by kind of just doing the numbers. I agree with that completely, too. I've always described it as asset hunting, that a lot of people can stay on the spreadsheet. And really on a spreadsheet, if you want to make it work, all you have to do is change a cell and then everything auto-calculates. Oh, look at all, the deal works. That doesn't mean it works because you haven't seen, like you said, maybe you didn't see what that 10-plex looks like at night. So you can think that it's a C neighborhood, and then you realize later that it's a D plus neighborhood, which is a different trajectory.
Right.
When you started with those 6-plex, what would you characterize those neighborhoods as? Because you said they were emerging. If you were giving them one of those letter grades, were they starting in these C minus areas, or were they as low as D? Because I think those are different management styles, better scale, but also a lot to do with.
I would say B or B minus, emerging into A.
Oh, that's,
really kind of waited to get on the train after it was running rather than start earlier on, just to make sure there was momentum there. And looking at things like transportation to jobs and the types of retail that was going in, and younger families and younger people moving into the neighborhood, which is always a sign of gentrification, which is a good way to invest in urban markets.
Yeah. Yeah. And I still feel like gentrification gets a bad name because it's seen as like pushing original residents out, but it's really the path of progress. It doesn't always have to, most cities still have affordable housing percentages that need to be there, but gentrification is pretty inevitable and overall will help the social scale of the cities that we're talking about.
I agree. And to the extent that quality product and more rental housing can be provided, then and increases in supply, that's kind of the market leveler on rent increases, which keeps rents attainable and affordable for all income levels.
Yeah. So as you started to scale up into larger properties, what did you decide to do else? Because I know at some point one thing I wanted to talk to you about is the differential now between building new versus buying existing structures and what you think about that, because I think on a large scale, there's some pros and cons really for both.
Right. We started to evolve to the point where I was looking to do larger transactions as we built up our own equity, as well as had outside investors approach us about providing equity, and decided to start doing more deals of scale, larger communities. And I focused on larger complexes that could have a standalone management office and manager, leasing agent, and maintenance person on staff, and started doing those deals. And then realized at different points in the cycle, when properties were selling at premiums, that we often could build ground up at a lower all-in cost than an acquisition cost of a fully stabilized property. It involves some risk and having to be comfortable with the area, knowing that we can get to lease up because you basically start with zero income and empty property. And we successfully developed a number of properties in the Houston, Texas market, as well as the suburban Chicago market, as well as Knoxville, Tennessee. And we did a fair amount of development over the last 5 or 6 years. And what I've noticed in the last year and a half or two, primarily because of the run-up in interest rates and the cost of construction loans, as well as the cost of materials, that it again makes sense for our company, at least, to buy and acquire existing stabilized properties because we can buy them at below the cost of construction, below replacement cost. And then
like construction costs have gone up. And with all of the bad debt out there, some of those acquisition costs have gone down, even though there was a long time where sellers were just being unrealistic about what the multifamily market looked like for them, right?
Yes, I think product that's available on the market, a seller that is selling into this market, which is depressed because of the capital markets and interest rates, is someone making a decision that they need to sell for some reason. Either a maturing floating rate loan, an equity investor that wants out, something like that. And those properties are selling for less than what they would have sold for in 2018 to 2020.
Yeah, for sure. Just going back a step, when you're building ground up for apartments, are you finding just lots that are already available, or are you doing knockdowns on existing structures? Like, how are those deals coming to you, and what do you have to do to get the land ready? Because I think non-developers who might be interested and have the resources might want to know.
Right. We focused on developments of larger scale. So we were looking for a decent number of acres. So we've only purchased existing land in areas that were growing, where we felt there was demand for additional apartments, and then went through the process of having the parcel of land entitled and rezoned to allow for multifamily, and built then ground up without demolition of an existing asset. Although I do think in the Tennessee market, we once bought a site with an abandoned warehouse on it, but it was similar.
Easy knockdown.
Similar to land only.
Yeah. So over your years, though, have you kind of seen a size of an apartment that where the numbers start to not matter. Like if you're over 50, it doesn't really matter if you go to 200. I've heard a few people say there's really like a number in the sand somewhere in terms of management, like you said, because you want to graduate to having everything on site.
Yeah.
Do you have any reference to what that number is where it really doesn't matter if you go above it, the management style is going to be the same at that point?
Yeah, I think for us, what we found is comfortable is a minimum for a new build of 100 units, anywhere between 100 to 200 units. We have built larger, which just requires more staffing, but I would agree and concur that in terms of asset management and oversight, it's just as easy to manage a 350-unit building as a 150-unit.
Yeah. Yeah. So during the construction phase for these developments, what type of research or how are you deciding on the unit configurations? That's always been interesting to me. If you're building 100 units, what demographics do you use to decide on 1 bedrooms, 2 bedrooms, or 3 bedrooms, things like that, and how many bathrooms?
Right. Well, we do pretty extensive local submarket research, and we often hire outside third-party professionals. There are firms in each market that tend to dominate, and we look at all the comparable properties that are currently existing and stabilized and see what their configurations are and what the demands are. We do a fair amount of extensive research by using CoStar and Yardi and on demand and rent growth at different levels, and we come up with a configuration. But the obvious rule of thumb is if it's a suburban market that is geared towards families, you need some 3 bedrooms and 2s. And if it's a market that's going to be geared towards singles or millennials, heavy on 1 bedrooms and some 2 bedrooms, many 3s. It's kind of the general starting point.
That makes sense. And that kind of scale of how you do that demographic research is a little similar to me to how people are doing self-storage research, because you're comparing facilities, trying to figure out what their configuration is and see where there might be more needed.
Mm-hmm. Yes.
Yeah. Hey, it's Jonathan, just taking a brief break from this episode to talk to you about Royal Legal Solutions. I had Scott Royal Smith on episode 92 of the podcast. You can go back and check that one out after you finish this episode. And he opened my eyes to how much protection I was losing every year that I didn't activate, build a team, and protect my assets. You can get information about Royal Legal Solutions by using my link at bit.ly/ZenRoyal. And bit.ly is bit.ly/ZenRoyal. You'll find a lot there. You'll find a 30-minute video to watch with Scott. And I can guarantee you what you hear on the podcast is exactly what you're going to hear in that video. So give it a try. I'm down the rabbit hole right with you. Let's get back to the show. What other asset classes have you got into, or have you always stayed in this general large-scale multifamily?
Really stayed in multifamily, but within the multifamily space, I, for a long time, was focused on student housing. We currently don't own any student housing assets, but for about a 10-year period of time, we operated on 7 large college campuses around the country with a student housing portfolio that we managed as well on our own, and enjoyed that business, but also learned the differences between conventional and student.
Yeah, I mean, I just know from the small scale college landlords, it's just a little bit more upkeep on what they know because they don't really know how to live on their own. So, the maintenance is more and more like, hey, this is how the thermometer, or the thermostat works. They just don't know stuff that they don't know.
Yeah, and the other big part of the student space from the financial matrix standpoint is, if you think about it, you've got 100% of your tenants either moving in or renewing in August every year. And if you miss the lease up in advance of that and don't get them moved in, you pretty much have a vacancy for an entire year. Whereas in the conventional space, apartments turn at different times. If something is slow in renting, you can run a special, you can offer a gift card, do a concession, and eventually get it leased up. It's not going to be empty for a year, but the student housing space was like that.
Yeah.
It was also a very short window to actually turn the units when the existing tenants move on, those that didn't renew, to get those turned over in a very short window all at once.
Yeah.
For a massive move-in August is a challenge.
Yeah, that makes sense because of the way that semesters block. Everyone leaves and comes at the same time, barring summer school. So it is like the changeover. You think, hey, that's not that big a deal. You should be ready for that. But 200 changeovers at once is a lot with all college students.
Yeah. And of course, there's, the college drama of 3 or 4 roommates and one roommate's not getting along with this one or that one that invariably the on-site manager gets drawn into.
Yeah, you almost become a parent. Co-signers are nice, but the parent co-signers would rather not have to handle the dispute over the common ping pong table or something.
Right. But it is a great business in a college or university town that has a large student population and where, of course, there aren't other choices like anything else, supply and demand. If there's a lot of dorm rooms or a lot of new product in the market, it's tougher. But where supply is constrained, it's a great business.
Yeah, and I could think that if you had the most organized version of a subset of college housing, you would have a waiting list that would never end just because they know, hey, this is the best one of the 7 out there. Right. Kind of like waiting for the best classes. They're trying to wait for the best potential residents so they could be a little bit, off campus, on campus.
Exactly. But I enjoy the pace of traditional, conventional business. It's less stressful and easier to recover from vacancies, as I mentioned.
Yeah. So over the last 5 years, though, let's just say since the pandemic, what's your acquisitions been like? Because a lot of people opted out. We were talking a little bit before that you're finding some potential acquisitions of existing structures. But what does it look like right now in today's market where we got through a tough time, but there's a ton of debt out there that people are, I guess, trying to, reconfigure if they can.
Yeah, we've done a couple of acquisitions. We're very cautious. We only look to do 2 or 3 acquisitions a year. We got into the single-family home rental space by purchasing a development in suburban Knoxville, Tennessee of 87 single-family homes. They were existing. We didn't build them. And they were all 3 bedrooms, same layout. We bought them in the last year, and they stay 100% full. Very high demand for that type of product.
Yeah.
With one of the homes as a model unit with an on-site manager and leasing agent as well as a maintenance guy. And that product and that niche, I think, is a great opportunity for future growth and high demand in the right area.
Yeah, that's an interesting one. When you bought the 87 units, were they already occupied? Did the people build to rent or did they build and then want to just get rid of it?
They were actually occupied and owned by a local investor who had been renting them for the last 10 years. They're about 10 years old.
Yeah.
And so it was up and running. We got lucky in that it's a real great quality school district in a great part of town where there's a lot of growth. And also in the fact that the local investor wasn't really a full-time real estate entrepreneur.
Yeah.
And rents were way, way below market. And we've been getting extremely outsized rent growth as leases come up.
Yeah, your value has probably doubled or tripled since then if they're so low.
Yeah, very low.
Yeah, that's an interesting product, though, because most people at some point, if they're hold as a developer, they're going to sell some and rent some and try to sell more. But were there other units in there that were purchased, or this was just 87 in one development that were all leased?
All in one development.
Interesting.
Yeah.
I think people are hoping that sounds like a good product. Those are hard to find.
It's a great product. And in terms of the renting experience, it's dog friendly for people who have pets in their own backyard. Got a garage. which is really nice, and a driveway. And since they're not detached, townhome style, they're single family standalone homes. You have 4 walls, none of which are shared.
Yeah.
So I think it's an attractive way to rent.
Yeah. And I mean, I think as now we hear a lot about trouble with affordable housing, regardless of the price. This is really a first time buyers type of thing, this type of development. It's the place where you get in, it's more development. So maybe a lot of the houses look similar, but it's going to be a safer, easier buy-in to start.
Yeah. And it's a place for people that either current interest rates keep them out because of the mortgage payment, or they don't have the down payment to purchase a home.
Yeah.
Or someone that's going to be in a community for a year or two and, doesn't want to risk owning a home and having to get in and out in a couple of years.
Yeah. And having only a 10-year-old product for all of them, you're open to the lower, FHA loans or something are going to pass. It's not going to be a problem. That would be for purchases, but you're getting a ton of good renters in who are going to be future buyers in the area as well.
Yes. And then the other acquisition area that we've been looking at, aside from continuing to look in all the markets that we're at, we're really highly focused currently on our home base in the Chicago market. We've been in and out of this market a lot, both with development and stabilized deals that we've bought and sold over the years.
Yeah.
And we see a buying opportunity because of many of the institutional buyers on some of the larger size deals are now sitting on the sidelines, either waiting for interest rates to settle or concerned about some of the headline risk that a city like Chicago is experiencing with the pandemic or local political scene or perception of crime.
Yeah.
And there are less institutional buyers in those urban markets. So we see it as an opportunity for us who knows the area and which submarket to buy in, like we've talked about at the inception here, is an opportunity for us to stand out as a quality buyer on larger deals.
Yeah, and a local buyer, much more preferred, the areas. But that goes back to, like you said, the other point, but also 2 of them, because it's such an opportunity when those iBuyers, they are working off of spreadsheets like we were talking about. So they can get, scared of these headlines where it's like, oh, yeah, great news that there's crime in Chicago or Philadelphia or New York City. Like, right. I mean, like this is new to anyone. But then when you really can go in, that, like you said, great opportunity. Any place where hedge funds or iBuyers are trying to buy and they're scared off seems like a great opportunity for local buyers, like you said.
I think so. And there's continued high occupancy because of some of the issues that we talked about with development. There hasn't been a ton of new product brought into many markets, Chicago being one of them included. So from a supply standpoint, there's not a lot of new stuff, and occupancy rates are very high. And a market like Chicago, among others, is continuing to experience rent growth, where some of the overbuilt markets with a lot of new supply are experiencing rent cuts recently.
Yeah. So just going back to the development of new products, are you finding that giving more amenities on these new builds that are doing can help you guys scale out better on rents than some of the older buildings that were just built as just like strict apartments? Is there a differential base in those for what people are looking for these days?
Yeah, I think so for sure, especially in the community area. Certainly the apartment itself, modern kitchens with quartz and stainless and the wood-like flooring is, great compared to an older building.
Yeah.
But in the communal areas, because of the number of people now that are either partially working from home or even fully remote, having an area where people can hang out outside of their apartment during the day and do some work from home or even do a Zoom call. We do some private glass enclosed rooms.
Yeah, I love that. Yeah.
Zoom call. And also a really nice fitness center, I find, is an excellent amenity where someone can not have the extra cost of a monthly gym membership.
Yeah.
Work out 24/7 on site, at their leisure. We tend to equip those fitness centers with interactive equipment like Peloton machines and mirror equipment, which are very popular. And it's really a great amenity that draws people to the place as well as keeps them there at renewal time.
Yeah, and also it's safe too. It's not a gym that everyone can have access to. Right. You're going to have card access just like to anything else or fob, and it makes it. Yeah, and it's funny. Like you can look at these big developments, and it seems like, hey, nobody's ever at the gym, but people just know when other people aren't going to be there. They get in this cycle of running, so you know how big the gym is when people are going to be there, and it's pretty easy to work out. And like you said, huge savings over what gyms cost right now.
Yeah, huge. And then the other thing too that really has become an amenity in and of itself in common areas is super high-speed internet, Wi-Fi. That's available to residents with a password at no additional charge.
Yeah, that's great. I really do see the differential in how you can, again, end up. I'm always thinking like waiting lists. That's always what I would think that you want as somebody with a bunch of units, like people wanting to get in there when there comes a unit up and quick turnover, lack of your vacancy rate will probably be much lower than some of the competitors in the area.
I agree.
Yeah. And I also think we're in an area of time now where a lot of people for their vacation, they're not going to go stay in traditional hotels. They're going to stay in short-term rentals. So amenities become even more important because their expectation of amenities on visits has become different. So it's nice to have those extra little things around their own apartment, especially as renters who sometimes have no amenities at all.
Right. And then the one we didn't touch upon too, which is obviously a suburban market, lends itself to it more, is outdoor spaces.
Yeah.
People enjoy pets, and we try and be pet friendly with dog runs and dog parks. You and I, like we were talking about, remember when renting someone with a pet was like a no-no. Now it's like we embrace them and we provide washing stations and dog parks instead of, a big sign that says no dogs allowed.
Yeah.
And fire pit areas to hang out, barbecue areas, and outdoor couches are also something that's a real nice draw for the community and a way for people to socialize and get to know their neighbors as well.
Yeah. And I think we were talking before about like kind of first time buyers who start out as renters, but I also see it a lot for downsizers. My dad, at some point, they moved to Florida and he lived in PGA National. Like everything was there. Yeah. It was a separated house, but he wanted to be in a place where there was golf and tennis and, a fitness area, like you said, that you could just pay one fee and get it all. You really didn't have to leave. Even the supermarket was accessible from inside. So
yeah, I'm finding I don't have a fancy statistic for you, but I'm just finding that the empty nester market of the boomers selling houses that want to stay in a community, perhaps because their kids or grandkids are there, maybe they're snowbirds and they're away in Florida or California in the winter, are more and more renting apartments in the suburbs near where their single-family home was that they've sold.
Yeah, and I mean, I think that's a really good point. You can look at it for people who want to downside. It's a great time to sell in a lot of markets. There's no inventory, but maybe there's no reason for someone who's in the downsizing stage to buy another home, and renting is a smart move because they have fixed income or they know what they have and they don't want to, put it into another house that they feel tied to.
Right. I agree. There's definitely a market.
Yeah, and that goes to, high amenity rentals as well.
Yes.
Yeah, really interesting. Are you so you're just going to stick to, did you never have the kind of like interest to try to branch out, or you're just really comfortable? Like, I just like multifamily. No one ever dangled like industrial or self-storage in front of you and you thought, hey, well, maybe.
Yeah, I've had those maybe, and that back to reality. And I learned.
Yeah, but why though? That's important though for others to know. Why did you stay in the lane? Obviously it's working really well, but what keeps you from jumping where there's so many people now who have shiny object syndrome and they see something new? Oh, I want to try this. I want to do, short-term rentals and self-storage. Right. And you're not going to be good at all of those.
Yeah. I mean, I've just learned that over the years of developed expertise and really know a lot about multifamily. I think we don't get surprised by anything. We know everything that could happen at a property, both good and bad. And then those new areas, like you said, the grass always looks greener, but there's also issues that I don't think we're smart enough experience-wise to know about. And at this point in the evolution of our company, I don't want to do a bad deal or have a problem. It's not worth it.
Yeah. So in terms of your company, MZ Capital Partners, you guys obviously raise equity for deals as well. How is that, though, getting started with the equity raise? It's always tough in the beginning. Obviously, now you guys are pros at it, so you probably have people who are going to be repeat customers. But what do you think the biggest struggle is in getting equity now as a bigger syndications?
I think the bigger struggle for someone new starting out is the lack of a track record and, the lack of a network.
Yeah.
And having to start small. And I would just, my advice to anybody starting out, similar to how I did, is you start out at smaller deals, use your own capital or borrowing, and then, typical friends and family, and the word starts to spread and get out. I was fortunate to have a nice network and a track record on my own that grew and got some recognition and got people to start asking me if ever I did a deal, would I be interested in taking in outside investors, and kind of grew from there in terms of referrals, and word gets out and slowly built up a following. And because we are selective and because we only are looking for 2 or 3 deals a year, although of larger scale, as you mentioned, we've developed a nice following and a nice return, and our syndications end up selling out very quickly.
Yeah. And as I look through your history, it looks like you've been a big participant in the real estate community over the years, in a bunch of different organizations.
Yes.
That obviously, I'm sure, has helped you grow as well, just kind of being around a lot of the people in the space all the time so you can bounce ideas and deals off of each other.
It's helped tremendously for the networking and the experience and the ability to call someone and get their input on something. It's also helped, I believe, establish credibility with lenders and investors, and certainly with the brokerage community, which is very important, because where there's an attractive deal and there's competing bids, you want the reputation with the broker to recommend to the client that these people are closers and credible, and if you select them, you're going to end up having a closing, not just entering a contract that blows out.
Yeah, I really agree with that. And I agree with it all the way down to like bare bones, 1 unit residential, all the way up to high scale commercial. Those reputations, all of us who are listing properties always want to work with someone who can close, has control of their client, and wants to work like as collaborators on, hey, let's all get to the finish line so everybody's happy in the transaction.
Yeah, I agree.
Yeah. Awesome. Where's the best place for people to get in touch with you? Is that mzcapitalpartners.com?
Yeah, that would be great. Our website is mzcapitalpartners.com. There's contact information if you click on, and just ask them to forward it to me, and that's probably going to be the best.
Awesome. And any new ones that are coming to market for people who are looking to invest in syndications?
Not at this time. We're always looking for opportunities. We're close on a couple. But if they're interested in general, if they just reach out to me through the website, I'll make sure they're on our list.
Yeah, great. All right, Michael, thanks so much for coming on the show. I really appreciate it. I like to talk old school with people. It just feels better.
Take care.
Yeah, all right. That was Michael Zaransky of MZ Capital Partners. I'm Jonathan Green. We'll see you next episode. Wait, you have reached the end of the show. This is the part where you're going to get ready to check out, but I've actually changed this part. For over 120 episodes, you heard the same thing. Well, now I've changed it. I've thought about doing intros to the next episode, but I'm going to hold off on that for now. These are my pitches at the end. I've got nothing to sell you at all, but I do want to remind you that it really would help us if you support the podcast in the right way. All that means is subscribing to the podcast so you get it on Monday and Thursday, writing us a 5-star review if you believe that we deserve a 5-star review, sharing it with your friends, and being a participant in the Zen and the Art of Real Estate Investing community. Soon there's going to be a new website launched. Maybe when you're listening to this, it's already going to be out there. That's where we're going to have collaboration. You're going to be able to see a lot from the guest. It is coming soon, and I just want to tell you, from me to you, I don't know how I got here, over 100 episodes. I'm so appreciative of you listening to the podcast and especially sticking around to hear this part. We'll see you next episode.